Okay, so when we say consolidation, what do we mean by consolidation? So consolidation is the what? Is the art or maybe the process, or consolidation is what? Is the combination of what? Two or more statements of financial position of what? Of companies, right? It is the combination, right? It is a combination of what? Two or more. Two or more what? Financial statements of what? Of companies. So that's simply what it is all about. And this one is what? It's a historical what? Financial statement of business that they combine them what? Together. So that means
Okay.
you that
Yes, sir.
means so the here that means here this is these are what we are talking about here. One is the combination of what? Statement, profit or loss, and what? And comprehensive what? Income. And two is a what? Is a combination of what? Of what? Financial what? Position of position at the end of the accounting year. And three, the combination of what? Cash flow. Right? So we will handle them one after the other. Please are you with me? Now, this is
Yes,
what
sir.
consolidation. So we consolidate what account of what businesses at the historical what basis. Now, when you look at what we call IFRS 3, IFRS 3 is what? Business what?
Combination.
Business combination. Now, when we look at business combination, the focus of what? Of business combination is what we call during the what? Is what? Is what? It's called what? Like it deals with what? Only acquisition of what? Of business. You understand? So what do you do?
Yeah.
What do you do when you are what? You are acquiring what? A business. So that is where IFRS 3 comes in. You understand? After acquisition of what? Of business and IFRS 3, then you go to IFRS 10. You see, that is where you do what? You continuously what? Consolidate account of what? Of businesses over the period. The difference between the two is that with regards to IFRS 3, it happens what? You understand? It happens
Yeah.
only what? Once. You understand? So when you look at this one, the IFRS 10, that one is on ongoing what? Activities. That means
Operation. Activity operation.
every year you consolidate business under IFRS 10. When you look at IFRS 10 and then IFRS 3, I will come and talk about the issue regarding what? The IFRS 3. I'll come and talk about issue regarding the IFRS. That is what? Acquisition. During the acquisition, what you should do.
Okay.
You understand? These things that you should do during what? Acquisition, which is
Acquisition.
under IFRS 3, business combination, right? Okay, so before the business combination, let me show you, or let me talk about exemptions. When it comes to exemptions of what? Exemptions from what? Consolidating account. From consolidated. At which point do we say that an acquirer cannot consolidate the acquiree? That's what we call the exemptions. Please, I agree. So at which
Yes.
point do we say that you are acquired, but you cannot consolidate the acquiree? You say you've acquired a business, but you can't prepare consolidation account for what? For the acquiree. One, you say you will never know. Sometimes a question like this may what? Become as an additional question to the main question. You understand? So the reason why I try to put it. So one,
Thank you.
maybe the parent itself is a wholly owned subsidiary. subsidiary. To another company. You understand? So what this one means is the parent cannot go and consolidate another acquired subsidiary when it itself is what is an acquired company. Do you understand? What they mean is that assuming you have A, right? Company A acquired company what? Right? Now, this company A has acquired company B. So this one becomes what? Parent to what? To company B, right? And this one is what? Subsidiary, right?
Sure.
So in a scheme of things, this one should what? Should what? Consolidate this one. Are you with me? Now,
Yes, sir.
however, if company A is also acquired by what? By company what? Company C. You understand? Now you realize that company
Yes, sir.
A, you realize that company C is what? Parent to company what? Company C. So for that reason, this company A cannot consolidate
See.
what? Company B, because company C owns company A. Since company A belongs to company C, company A cannot consolidate company B. This is what we call complex group.
Okay.
Do you understand? So in that instance, you realize
Yeah.
that company C, though didn't buy company B directly, but because company A belongs to C, automatically company B belongs to C indirectly. You understand?
Yes, it
So
has an influence.
we call it complex group. Now, so for that reason, company A cannot consolidate what company B. Are you with me? So
Yes,
that's why we say
yes,
the
sir.
parent itself is wholly owned subsidiary or partially owned what?
Subsidiary.
Subsidiary. So you can't consolidate.
Another
So you put that one at the back of your mind. And then two, the parent's debt. The parent's debt or what? Or equity investment are not traded in the public. You see. So if you are you are company A, you've acquired what? Company B, right? So here you are what? You are parent. Please, can you your background? Subsidiary?
it's a motto from the top. Makati.
Your so here, so you are company A, parent, and company B, subsidiary, you acquired it. Now, here is the case. You, the company that acquired company B, you are what? You are unlisted. You are
Yes, sir.
unlisted company. Even though if this one is listed, you cannot consolidate this. It means their shares are not traded in a Ghana Stock Exchange.
Sure.
So if your shares are not traded in Ghana Stock Exchange, you can't consolidate, and you acquire the company, you can't do consolidation account. Are you with me?
Yes, sir.
That is three. And then the parent file. It is in the what? In the process. Can you see my handwriting? Of filing its what? Its financials. Financial statement. Security and Exchange. So here, what this means is that if the parent doesn't publish its what financial statement or does not what submit, you know that every company is what is obliged, or every company should submit its financial statement to what Ghana Exchange Commission. Compulsory. Do you understand? It's by law. So every
Okay.
end of the year, you should publish your financial through the Ghana Stock Exchange. So if a company, you don't submit your report for publication and you acquire another company, you cannot consolidate accounts. Do you understand? That is
Yes,
what
sir.
this point also means. That is it about that. You keep that one in mind. So now, when a company is going to acquire another company, the company is, well, the one who is acquiring is called acquirer, right? So let us see what we call identification
Okay.
of what? Of acquirer. So how do you identify that this business combination, this one is what? Is the acquirer? Are you with me? This one is the
Yes, but
acquirer. Who is the acquirer? How do you identify that this between this business combination, company A is the acquirer or company B is the what? Is the acquirer. So in order to know that this company is the acquirer, one, the fair value. If the fair value of one of the combination entities is significant, greater than the other combination entity, the entity with what? The entity with the greater fair value is likely what? To be the what? To be the acquirer. So what this one means is that how do you identify this company? This one is the acquirer and this one is the acquirer. They can ask you. You never know. It can come an additional question. So you have what? Company A. Company A. So maybe the net fair value of company A is what? 50 million. Then you come to company B. The net fair value is what? 30 million. So they said that the one with the greatest what or greater what fair value is likely to be what? To be the acquirer. You put it at the back of your
they
mind.
have made them. They are all company A, company A.
So this one is company B, right? Okay,
Yeah.
thank you. If the business combination through and what? An exchange of voting, ordinary what? Equity instrument for each. Okay, or other assets. Entity giving up is likely what? To be the what? To be the acquirer. So this is how you can what? Identify who is acquiring and acquiring. So here all that they want to mean is that you see when you are buying company or you are acquiring company, you have company A, right? And you have what? Company B. Just like we did yesterday, ICAG and then what? One touch. So look at this. Between this company, who is what? Who is giving the cash or who is giving out the cash? You understand? Who is giving out the cash? And we have so many types of what? Method of what? Payment of what? Of purchase consideration. So if company A is the one giving out money, you understand? Maybe they are giving cash, maybe the payment is through cash or maybe through shares. So if it is what company A that is doing that, then company A is what is the acquirer, right? And company B is what is acquiree. Do you understand? So that is what the point two is what talking about. Okay, so let's see the combination. If the business, can you mute yourself, please, so that when I'm done, then you can. So if the business combination result in what, in the management of one of the combination entities being able to dominate the selection management team. Okay, so when you look at point three, if there's a business combination, you have company A and you have what? Company B, right? You have two companies, and then the company A acquired company B. So here you have what? Company A acquiring company B. So here you realize that company A is what is the parent, and company B is a what is the subsidiary. So here parent acquired company B maybe 70%, and then the subsidiary has what 30% left. So in this instance, when that happens, you realize that now company B is what belongs to company A. Now on their board management level or board level, they need to have what representative both from both companies. So since this one is the parent, if the number of what of the members, maybe the total number of members is maybe, so you realize that the company which is the parent will submit 7, and then the subsidiary will submit 4. This order. So the company with the highest number of members on the management level or board level is likely to be the acquirer. So this is how we use to identify which company is acquirer and which company is what is acquiree. All right. So these are this is what I want you to understand going forward with regards to the business combination. All right. Now we have something that we call reverse acquisition, but I don't want to belabor the point on reverse acquisition. If you want me to explain, I'll explain. Other than that, let me move about what we call reverse acquisition. Let me move to forms of what? Purchase consideration. Now, forms of what? Purchase consideration. Now, we have one. When we say purchase consideration, at this level, you understand what purchase consideration is. Purchase consideration is how much the one who is acquiring the company bringing on board. You understand? So you have company A that is going to acquire company B. How much is company A going to invest in company B and acquire it? That's what we call purchase consideration. I believe you understand this. Now we have forms. First form is what? Cash consideration. Cash consideration. So this one is simple. All you have to do is that you should just bring in the cash, present the cash, and then take over the asset of the company. consideration. So please, at this level, I think I have started talking about IFRS 3 business combination. Do you understand? So let me list it properly here so that you understand what I'm trying to talk about here. So here, I started talking about IFRS. So here is what business combination. So now pertaining the acquisition or consolidation issue pertaining consolidation and all that, right? So I started talking about
Yeah.
exemption. At which point can we say that a company can consolidate another company, and what are some of the exemptions and identification of acquirer and acquiree. So now I'm coming to talk about. We are now coming to zoom into what acquisition of company. How do we acquire company? That's what we call
Sir,
business
so it
combination.
means here you've cleaned the forms of business purchase consideration.
It
That
all
is
forms under it. I'll bring it back.
okay.
I'll bring it back. So we are coming to talk about business combination proper. So how do we acquire business? Do you understand? You see, before you can prepare consolidation account, you should first do business combination. That's IFRS 3.
Yes, sir.
So before you
So your
can
line
do
went off.
Yes, so before you can do IFRS 10, you should first do IFRS 3, business combination. How do we acquire business? So how do we acquire business? That falls under this one. So here, that's what we have. One, forms of what?
Forms of purchase consideration.
Purchase consideration. All right. So forms of what? Purchase what? Consideration.
Consideration.
Now, one, we have what we call cash. So in this form, the company has the money to drop, right? So here, if company A want to acquire company B, which forms are they using to acquire that company B? You understand? So if company A has the money to outrightly buy the company B, they will just go and drop the money and acquire the assets of the company. You
Sure.
understand? So that's what we call cash consideration. Okay. The second is also called what? Deferred. Deferred consideration. Okay.
That is to be paid
Right.
in the
So
future.
here, I don't have all the money. Right. I don't have all the money. So what we will do is that, okay, they can decide to make part of the money cash consideration and the rest defer them and then pay it maybe 2 years. So assuming if the cost of the business is maybe 40 million. Now they can decide that out of 40 million, we'll pay cash, maybe 30 million. Now the 10 million left, we will defer it to maybe 2 years time to come. You understand? So that's what deferred consideration.
Sure.
Or maybe they can say that all the 40 million we will pay it in 2 years. So for now, we will agree, then we will take over the business. By the 2 years time, we will manage the business, give you your money that you requested for the acquisition. So that is what we call purchase, what do you call it? Deferred consideration. So now the third one, okay, so the third one is what we call contingent consideration. So when you come to contingent consideration, it's a condition in the arrangement.
Yes, sir.
So this one, with regards to contingent consideration, is what? It's, let me say, maybe additional payment to the acquirer based on certain conditions that should happen. Do you understand? So the condition is that,
Yes, sir.
okay, for example, maybe the company may say that, okay, the total cost of the company is maybe 50 million. Now we will let us pay cash of maybe 10 million. Now the rest of
Yes, sir.
let us pay cash of 10 million. Now the rest of the 40 million, payment
40 million.
should base on what? On condition. And one of the conditions is that maybe profit for the what? For the next 2 years should hit maybe 3 million Ghana cedis. So if the company is able to make 3 million Ghana cedis for next year, then we will pay the balance of what? Of the money. With regards to contingent consideration and deferred consideration, we will have a lot of things to talk about them, especially when example, like if you have deferred payment to make. So
Sure.
deferred payment, if you have deferred payment, so you have what, maybe 3 million to pay as the cost of what, of the business in maybe 2 years. What happens? How do you deal with for this 3 million that you pay in the next 2 years? Because we know that in accounting, when there's any defer cash flow, what did I say you will do? When there's any defer cash, what did I say you will do?
Defer cash flow.
Whenever there's a defer cash, what do you do?
That is, we wind.
So all you say, you discount it. Listen very carefully. You discount it to
then
what?
rewind. Yeah,
You listen to me. You discount it what? To the present value. Do you understand?
Okay.
You discount it to the
Yes.
present value. Now, when you discount to the present value, because you are paying it in what? In 2 years, and assuming you discount this 3 million to the present value, maybe it can give you maybe 2.5 million. 3 million. You can, when you discount, maybe example, maybe it can give you what? 3.5, 2.5 million. You understand? You discounted it at what? At maybe 10%. Are you with me?
Okay.
Now,
Yes, sir.
now it says that when you defer a cash that you pay in a future, it is like a loan to you, right? So that means
Sure.
every year you pay this finance. There's a finance cost component on it, because by the 3 years, listen very carefully here. By the 2 years time you pay the 3 million, the 2.5 principal that you pay plus the what? Plus the interest should sum up to
Yes.
equivalent to 3 million per. Do you understand?
Okay.
The interest is
Okay.
what we call unwound.
Thank you.
Do you understand? Good. So
Okay.
we'll deal with these matters along the line. Slow. We'll get there.
Thank you.
Okay. So the last one that I would like to talk about is what we call share exchange. Okay. So how do you understand share exchange? How do we measure share exchange? So in this case, the company is not paying paying for the acquisition of the company through money, but through what?
Share exchange. Equity. Share exchange.
So how do we do it? Do you understand? How do you do it?
So you have to come into terms with them and tell them, if this is how much they are giving, this is how much. Yes, you wanted them to be part of the business, so you are giving them this amount of shares, so that even though they've sold the company to me, they'll still be part of the business
Okay. So
by that portion of
just like we did yesterday. You remember when
ordinary shares that they have.
ICAG was acquiring One Touch? You remember the question under external reconstruction? You remember what this one means? Maybe if you have company company A and company B, right? So the company A is the acquirer and the acquiring company B. So all that they will say that, okay, we
Yes,
want
sir.
to acquire this company through what? Share exchange, right? You want to acquire this company through what? Share exchange. However, instead of we giving you, right? Instead of what? We giving you what? Cash. We will give you share exchange of maybe 1 million shares. You understand? So they will float this 1 million share and give it to Company B
Okay.
to subscribe. Do you understand? Instead
Yes,
of
sir.
them giving them money, they will give them what? Shares. You understand? So here, if they are giving, they will say that, okay, we will give you 1 million shares at maybe 0.5 Ghana cedis. You understand? So this is what we call share exchange.
Okay.
So you just multiply, then you get the number of what? Share value. You understand? And this one, and this one, and this one will be, and let me, I will explain this one. And this one, how do we treat this one? So let me give you step by step how these things are also treated when they acquire the company. Are you with me?
Yes, sir.
Good. So here, what happened in the treatment of this? What happened? You understand? So if maybe they acquire the company through cash, in the balance sheet or statement of financial position of what company, how is the treatment going to?
Yes, sir.
When they acquire the company through cash, when they acquire the company through cash, what happens? You will see that the balance sheet of the combined business, you debit cash
Sure. Because cash is coming.
because cash is coming in.
Sure.
Are you with me? Uh-huh.
Yes, sir.
Because cash is coming into the business. So that's the purchase consideration. We acquire the company through the cash, right? So if you acquire the company through the cash, what are you acquiring at the end of the day? You know that at the end of the day, they will tell you that they acquire maybe 70% of what of the company. So when they acquire the maybe 70% of the company, what are they acquiring? Are they acquiring asset or they acquiring equity share of the company?
They're acquiring equity share of the company.
So now if they are acquiring the equity share of the company and they paid cash for it, what will be the treatment?
So,
That's what that I want you to tell me.
okay, if they pay, they are using equity. So equity is will credit the equity shares, and then we'll debit the cash.
Is that it?
Uh, the cash is coming in on our side. That is
You realize that,
that's the
please.
understanding
No,
of the
no,
legends.
no, no, no. Have patience here. Let me tell you that. Let me go on with it. Then we shall. Let me simplify it. Have you seen that when you take a cash, when you bring in the cash, do you understand?
Yeah,
So in the books of
yeah,
subsidiary, watch here. In the books of subsidiary, it will look at the subsidiary are receiving cash in their books.
yes,
It will look at the subsidiary is receiving cash in their books. However, when you come to the combination, there's no cash coming into the combination. This is how it's going to. Cash will rather reduce the combined company because you see, they said that when there is transaction between two companies, a combined companies, we eliminate the transaction outrightly. Assume like company A cannot sell to what company B and make profit.
no,
Do you understand? Aha. So in the combination, when it's it's an actual money that is coming in, it's not actually when you come to the combination, it is rather reducing the cash available. It means the cash side
okay,
it will reduce. Do you understand? And it
because we
will
are the same person.
you understand you are the same person, so it will reduce your cash balance in the
Cash.
combination, right? But it will increase your goodwill and the deferred consideration. When deferred consideration is also they bought also through deferred consideration, that one too will go to long-term liability,
Thank you.
and then and short-term liability. That deferred consideration will these are the places
Ugu.
that deferred consideration will go. Do you understand? So the fair consideration will go to both long-term liability and short-term liability. Do you understand? And what do you call it? Cash purchase. The effect of cash purchase will only affect what? It will only affect your current assets, the effect where it will go, right? Now when you come to both both both
Yeah.
both contingent liability and deferred consideration have the same treatment. Now when you come to share exchange,
Yes, sir.
the share exchange, the effect will go into equity capital. You take note of that. Do you understand? So these are what I want you to I want you to take note. Are you with me?
Okay.
Aha. So this
Yes,
one,
sir.
the effect of what? Of this one, they are what? Deferred consideration and what? Contingent. The effect will be the same, right? So if it's share equity, the effect will be in the equity
Sure.
capital. So that is it about what? About method of what? Method of acquisition. Okay. So now let us move further and talk about what we call step in what? In consolidation. So steps in consolidation. One, determine what? Control structure. Determine control structure. When we say control structure, a company bought another company, right? So when they bought the company, what are the percentages in their what? In their acquisition? That's what we call what? Control structure, right? So if maybe company A acquired company B at 50 million. The total shares acquired by A is 600,000 out of what? 100,000 shares of what? So what do we do? So all you have to do is that now here you have the acquiree, the total shares of what? Of company B, the one being acquired is how much? It says it's what? It's 100,000. So here,
Yes.
what is
So
the
the
what?
board is gone.
You have it. The total shares in company B is 100,000, and company A acquired how much of what? Of the share? How much did I say? No, I said 60. No, watch here. Company A acquired company B
600,000.
at 50 million. The total shares acquired by what? By company A is what? 600,000 out of maybe, let me say, this one should be 1 million shares.
Exactly.
So here,
Thank you.
so here, so company A acquires 600,000 of what? Of the share. So the control structure, you will have to come and do it this way. You will have what? 600,000 divided by what? 1 million shares of what? Of the company times what? Times 100. What do you have? 6/10 is how
Okay.
much?
Let me divide it, sir. I've acquired new 60%, sir.
Okay, so they acquire what? 60% of what? Of the share. So here, your control structure. So when you are coming to the control structure. So control structure, you have what? Your parent and parent, 60%, and then subsidiary, what? 40%. Total should give you 100%, right? If you like, you can bring their
Yes, sir.
names of the company there. So that is the first step of what? Of determining the what? The group structure. So now the second step that you will do is what? Determine the net asset of what? Of the subsidiary. So two. You determine the net asset of what? Of the subsidiary.
Yeah.
Right? Okay. So in determining the net
Okay.
asset of subsidiary, what do you do in determining the what? The net asset of what? Of the
Subsidiary.
subsidiary. All right. So here you have what we call at what? At acquisition. You have what? And then what? Post acquisition. So that's how. Now let me throw in some of the likely items that you will see in your what? In your question likely. Maybe your share equity. When they came to what? To acquire the company. Watch here. When they came to acquire the company, or when the parent you came to acquire the company, what is the total share value of what? Of the subsidiary? Do you understand? So when you came to acquire the company at the beginning of the accounting year, the share capital is how much? Maybe X, maybe 50 million. At the end of the reporting, the share capital they didn't change, the same as what? 50 million. Do you understand? Do you understand? So when you are done, then you will less it. So whatever you get will give you what post acquisition what of the
Value.
subsidiaries. Right? Okay. You also have what you call the income surplus. When you came to acquire the asset, because here they are talking about acquisition of what of the subsidiary asset, net asset of what of the subsidiary. So you start with what? With the share capital. So when you are done, then we also look at some few adjustments to be done with regards to that. So when you are done, then you come here. You also look for the income surplus. How much was what was income surplus when you acquired it? At the end of the account here, how much is the value of what? Of the income surplus. Whatever you get will also come here. You will less it, then that will give you this. You understand? Because
Sure.
maybe when you came to acquire the company, the income surplus, because you know that maybe you acquired the company in 1st January 2024. At the end of December 31st December 2024, what is the income surplus? Because the income surplus, when you acquire the company, maybe the income surplus is 40 series. At the end of the accounting year, the company might have what? Gone on to what? To trade. The subsidiary gone on to trade after acquisition, or it's gone on to trade. So when it traded, maybe at the end of the day, they had net profit of maybe 60 60 million, right? And they said that okay, out of 60 million, they what 10 million as dividend to each shareholder. So the 50 million left become what? Become part of what? Retained earnings, right? Or it becomes your net profit or earnings that will go to the balance sheet at the end of the accounting year. So you realize that when they acquired the company at the beginning, the income surplus was 40, but at the end of the accounting year, they traded. So profit and loss account, they had what maybe 50 million left after giving the shares dividend. So this 50 million becomes what
So
your
there's been a change.
retained earnings.
But not all.
You
You take
understand?
your portion.
So so the 50 million becomes your retained earnings. You understand? So this one, they will add the 40 million plus what? Plus 50 will give you what? Will give you 90.
Earnings. Thank
You understand? So you realize that when you
you.
acquire
90.
you realize that when you acquire the company, the income surplus was 40. But at the end of the accounting year, the income surplus now is what? 90. So the difference will go as post
90.
acquisition what? Profit. You understand? So that's how we report these things. I believe you are following me. I believe
Sure.
you
Sure.
understand.
Sure. Yes, sir.
Good. So that is how that one is done. So you also talk about maybe retained earnings. So I've already explained these things already in there. So okay. So let's move again. What can you see under your retained earnings? You can also see this one. That means we are done with what? With your equity. If there's nothing again to talk about, maybe you can even have what we call revaluations. You see, when you have revaluation, all of them under share equity, you bring them here. So assuming we don't have maybe anything, right? Or maybe let me
Sure.
bring it, maybe revaluation. Do you know revaluation?
Yes, bro.
Okay, so or maybe revaluation reserves. You understand? So revaluation reserves. So let
Yes.
me bring them. Maybe reserves or revaluation surplus. So if they are there, please bring them here. All of them are under equity. Okay, so assuming we are done with equity issue. Now, you now go into the additional information to look for asset revaluation gain or loss on assets. IAS 16. Go into the statement of financial position and look for it, or additional information and look for it. Do you understand? So here, we have maybe revaluation gain on assets. Now, revaluation gain, example, maybe if in the coin they will tell you that PPE, they have PPE of maybe 60 million. In addition, they will say that PPE has what? Has valued by 5 more than 8 what? Book value. You see, these are some of the terms that they will be using. So you should be very careful. So here, when they say this one has valued more than 8 what? carrying book value, it means it has gained in value. So you will bring it here. So that means how much has increased? It means 5 million has increased. Then you bring that revaluation gain here. What is how much? 5 million. You will bring it here. When there's so they can give it to you in this form. So it means the asset has what? Has valued, or the asset has gained in value. PPE has valued by what? By 5. More than 8 book value. You understand?
Right.
More than, so that means there's a revaluation gain of 5 million.
Yes, sir.
You understand? So that 5 million, you will bring it here and you will bring it here. The same value. 5 million here, 5 million here. When you less it, here will be what? Here will be what? Here will be 0. So that's how it will look. Now, when you are done, then you need to what?
Yeah.
Calculate depreciation on this revaluation of what? Assets. You understand that you calculate depreciation on this revalued
Okay.
what amount. You understand? And you know that revaluation or depreciation is calculated at the end of accounting year. So here will be nothing.
Good. Yeah.
Do you understand? Here will be nothing. Then you calculate the
Okay.
depreciation here. You understand? So when you calculate depreciation, you know depreciation what will be less from what? From the value of what of the asset. So here will be what will be in bracket. Do you understand?
Okay, sir.
And there will also be in bracket. Please, are you following me?
Yes, sir.
Good. So how about this? So now maybe they said that revaluation loss. So here the
Evaluation
narration
law.
they will say that PPE, they can make PPE is maybe 40 million, right? And they can say that okay, in additional information, they will say that PPE valued less than 8 what? 8 book value. It means there's a revaluation loss value by maybe 2 million. It means that there's a revaluation loss on the asset, and the revaluation is what? 2 million. Do you understand? So here, all you have to do, you bring the 2 million here and bring the 2 million here. Are you with me? That's revaluation loss.
Okay.
Now, sometimes if you are lucky, they will not bring you this long English. They will give you PPE. You go into the P&L, you see the PPE, and they will tell you that now the PPE revaluation of the what of the PPE is maybe 38 million. You understand? So here you have to compare the two. Has a PPE reduced in value or increase in value?
Oh, this year it has reduced in value.
It has reduced in value. So there's a revaluation loss on what? On the asset. So here, then you come here, then what do? You will come and what? Less the
The,
what? You will come and
the value.
less the what value here.
So that one it's from the beginning, eh?
No, loss. Are you talking about
But,
loss?
no, with the depreciation, the explanation you gave, that depreciation comes at the end of the year.
Yeah.
So we cannot see depreciation at
Yeah.
the acquisition period.
Yeah.
So this one it will not go away from me. PPE value loss. That is what we are on.
We are
So
on
that
it.
one,
Let
yeah.
me finish. So when we are done, so the same amount, if it is 2 million, you will bring the 2 million here, 2 million here loss, then here will less with nothing. When you are done, then you calculate depreciation on revaluation loss too.
Okay.
And I've already told you depreciation is calculated at the end of the accounting year.
Yeah, yes, sir.
Right, so you calculate depreciation, and here because the revaluation loss is what is negative, the depreciation will be positive here. You add it, so whatever you get will come here.
Okay.
Do you understand?
Okay.
If it is loss,
Yes, sir.
if the revaluation is low, depreciation is positive. So if you have maybe a contingent liability, bring it here.
Okay.
Contingent liability, if you have contingent liability, because it's a liability, it will always be in brackets, right? Beginning and
Okay.
then at the end, if it is the same, then all of them will be negative like that. Okay,
Yeah.
good. Now we have what we call unrealized profit on inventory. This one, some people choose what take it elsewhere, but I do the what sharing here already. Some people decide to take it to what do you call it, the non NCI or subsidiary, and then retain earnings of what of the parent to share. No, I share it what? Here. The unrealized what? Profit, right? When we say unrealized profit, or we call it provision for unrealized profit, PUP, provision for unrealized profit on inventory. So with this one, it is simple. Here we what? Here will be what? Nil, yeah. Then you less it. Provision for unrealized profit. You will less it here. What is provision for unrealized? When you say provision for unrealized profit, what do you mean? When a company, we say that two companies can also, you have company A trading with what? With company B, right? So here, maybe if they traded during the, after acquisition, they traded. Do you understand? After the acquisition of what company, they made the trading of maybe 20 million. Do you understand? Now, out of this 20 million that they traded, they sold. Do you understand? So this one, company A. So here, before it comes here, you ask yourself, between these two companies, who is making the profit of what? Of the sales. Do you understand? If there's a subsidiary that sold, so let me turn it here. If the subsidiary that sold, that made the transaction. Do you understand? So here, the subsidiary, this is subsidiary, and this is what? Parent, right? So subsidiary sold to the parent. So who is making the profit? Who is making the profit?
So say sold to the parent. Then the subsidiary will make the profit.
So the subsidiary is making the profit.
In the normal business.
Good. Then the PUP will be treated here. Provision for realized profit will be treated here. Are you with me?
Okay. Yes, sir.
Good. So if it is parent that is making the profit, then the PUP will be treated in what? In retained earnings. Who is making the profit? So since we are doing with what do you call it? Net asset of subsidiary, we will maintain this. So here, if it is subsidiary that is making the profit, so the sales is already made. They made a sale of what? 20 million. Do you understand? During their transaction. So during the accounting year that they are coming to do the accounting, right? Do the accounting, they have unsold goods. Out of 20 million that they transacted, they have 5 million unsold. Have you understood? They have this 5 million unsold. So out of this 5 million unsold is what we will calculate what we call our PUP, provision for unrealized profit. Less. Do you understand? As for 20 million that they transacted, we will remove it from the books. Have you seen this 20 million? We will remove it from the books in the what? In the profit and loss account. As for 20 million transacted, we will eliminate because they are company. Then they cannot do business together and make profit for themselves. So what we will do is that these 20 million will be removed from what? From their books through P&L. So when we go to P&L, we will remove it from what? From the revenue, and as well as remove it from what? From the purchases,
the
cost of sales. I'm saying that we will remove it from their books. And I'm saying that they are not supposed to transact because they are single entity. So we don't need to what? Retain it from in their books. That's what I'm saying. And where do we remove this one from their books? In the P&L. And I say that we will remove it through what? Through their revenue and what? And their cost of sales. That's what I'm saying.
Okay.
You understand? Because when you go to revenue, it's the combination of what? Company A and company B. Their revenue is what we and and this transaction is already will be part of what? Their revenue. You understand? And we have to remove it from there. And how do we remove it? We remove it from revenue and also remove it from cost of sales. Because why are we removing it from both? Because somebody has sold to company A, B has sold it to company A. Can't you say that it will form part of their revenue here?
Sure.
And the one who also purchased, who made the purchases, and the purchase is part of cost of sales. Can't you say that it will also form part of what? Cost of sales here?
Yes.
So it will be removed both here, both ends. You understand? So it will be less. You understand? But I'm talking about what? Unsold goods, the 5 million here, where we have our PUP. And they will give you that they will give you to remove the unrealized profit from the unsold goods, and they will give you maybe 20% markup, right? So all you have to do, you pick 20 over 120, then you multiply by 5 million. You understand? So that will give you the provision for unrealized profit here. So when you will get it, then you will bring it here. You understand? You will bring it to the to the at reporting, and then also post reporting. Do you understand? Okay. Post acquisition.
Yes, sir.
Some people don't do it that way. Some people, when they get the answer, they will go and then share it between the subsidiary and then the parents. But I see it to be long. If not, you may even forget. Why don't you treat it at once here?
Okay.
You understand? Why don't you treat it as once here? Because post-acquisition profit will be shared among the parent and subsidiary, and it will form part of it. So these are some of the items you will be seeing. So let us go to the third one, which is determination of determine goodwill. Okay, determine goodwill. So how do we determine goodwill? Now, under the goodwill determination, we have two methods, or let me say methods. Method of determining goodwill. One, we have what we call proportionate method. And then we have what we call fair value method. I'll pick them one by one. Now, when I pick at which one do you
Okay, sir.
At which point do we use the proportionate method? When company A, the parent, acquired company B. Watch me here. When company A acquired company B, right? Okay. So after acquisition, maybe company A acquired company B at maybe 50 million. That's acquisition. So after the acquisition, maybe now the parent owns 60%, and then subsidiary is how much? 40%, right? Okay. Now after the acquisition, maybe the shares that the parent acquired here is 600,000.
Sure.
Maybe the total shares. The total shares.
1 million.
Okay. Total shares is 1 million.
Yeah.
Right. So these are the total shares. And this one parent acquired 600,000 out of the so we are left for 400,000 for the subsidiary. Is that not the case? Okay.
Yes.
So after the acquisition, after the acquisition, and in the question they said that maybe they can state in the question that maybe due to, or they will state, or maybe in the question they will state nothing. They will state nothing with regards to fair value.
Okay.
Fair value share price of of subsidiary. It's not known.
Yeah. Okay. That is in the note.
In the notes, if they don't state, if they didn't tell you the fair value price of the subsidiary, unit share price of the subsidiary, it means that the subsidiary is not fair valued. If they don't state anything with regards to the subsidiary, it means the subsidiary share price is not fair value. That is when we use proportionate method to determine the fair value of it. But if in the question they said that, okay, the share price, the parent is maybe 5 cedis, and subsidiary is maybe 4 cedis. Then in the question they will further say that non-controlling interest. You know that non-controlling is the same as subsidiary, right?
Sure.
So non-controlling interest fairly value, or use fair value to determine that. So here it means that we can know the fair value of subsidiary. So how do we know the fair value of subsidiary? All you have to do is that you will pick the shares of subsidiary, which is 400,000.
Sure.
Multiplied by the share price of 4 cedis. So this becomes the fair value of of the subsidiary. So with this one, you know the fair value of the subsidiary. But in a case where the question is silent, they didn't give you the unit price of subsidiary or non-controlling interest. The question is silent. It means that subsidiary is not fairly valued. So you use proportionate method to determine the goodwill. If the subsidiary is can be fairly valued, then we use what we call fair value method to determine goodwill. So here, if we are using the proportionate method to determine the goodwill of the business combination, how do we go about it? All that you have to do is that you just pick the purchase consideration, or we say goodwill. So you pick purchase consideration, blah blah blah. Watch here, you pick net assets at acquisition. The percentage, do you understand? The percentage of that net asset that you multiply, whatever you get, then you come and less it. So whatever you get is your goodwill. Simple. So this is your goodwill. So here, if the NCI is not fair value or non-controlling interest, so this
times what?
percentage times
the amount, eh?
the amount. So the amount of net asset at acquisition, something like this. Come to the net asset of the subsidiary as I did here. This one.
Yeah.
You understand?
Okay.
So this one, the value here is what I'm talking about. I'm talking about this value. This is what
I've said it, sir.
This one, the one in red.
Yes, sir.
That is what we call the net asset at acquisition. So that is what we will bring here.
Okay.
But some
yes,
people, some people
taking it out.
Some people also have alternative that they can do it this way. But I see that one to be long. They bring their purchase consideration, then they will bring it here. So if assuming the subsidiary percentage is maybe 40%, then they will come here, then they will say add net assets at what? At acquisition. So they will pick the 40% here. They will pick the 40% here and multiply by what? At acquisition, this one. What I showed you up there, the one in the red.
Yes.
They will pick that one. They will pick that one and multiply by what? By the percentage of what? Of the subsidiary, right? And they will come and add it here. Add it to this one. So when they add, then they say less what? Net asset at what? At acquisition. Then they will less the total, this one, to arrive at what? At goodwill. They will pick the one that I made red in they will pick the total of this and come and less. But initially they will multiply by what? By the 40% of the subsidiary and add it to a purchase consideration here. Then they will come and say less net asset at acquisition. But you see, this one is long. So simple. Why don't you just pick the net asset at acquisition? They multiply by a percentage of the parent. This percentage is for the parent too, not subsidiary. This one.
Yes, sir.
So the percentage is for the parent. Then you just less, that gives you what to go. So this is when the asset is not fairly valued. But if the asset is fairly valued, then you use what we call fair value method. Now, under this fair value method, it is simple. It means the asset is fair. So that means the subsidiary is what? Is fairly valued. It means at the end of period that we are doing the consolidation, the subsidiary, we know the fair value of subsidiary. They can give it to you in the question that the subsidiary is fair value at what? At maybe 500,000. That is fair value. Or they can give you maybe a subsidiary shares is maybe 500,000 at 500,000 shares left for subsidiary 500,000, and they will say that at what? Maybe 1 Ghana cedis. So you realize that the fair value of the subsidiary will be what? 500,000 multiplied by 1. That gives you what? 500,000 cedis. So it means the subsidiary is what? Fair value. So that one you use what? Fair value what? Method to what? To determine the what? To determine the goodwill. So now I have to bring NCI under the what? Proportionate method. You
Goodwill
understand?
operation. Okay.
So I have to bring the what? The NCI fair value under the what? And so how do we? So after you are done using the proportionate method, how do we find the what? How do we find the NCI or non-controlling interest of what? Of the subsidiary. All right, so that's what? Non-controlling interest. So this is 4. That is
Yeah.
4. So non-controlling interest. So now, how do we find the non-controlling interest if it is under its proportionate method? So
Okay.
so you should understand is that if it is under proportionate method, how do we find the what? Non-controlling interest portion. You understand? So non-controlling interest portion, how do we find the what? How do we find the non-controlling interest? Right? So it is simple. You will just pick the what? You will just pick the percentage, like the net asset at reporting share of what? Of the NCR. Simple. So you come here. So you just say what? A net asset. Net asset at reporting multiplied by what? Share of what? Non-controlling interest. So here, all that you have to do is that maybe you pick at reporting. Have you seen? Look at the at reporting. So you go to your at reporting. Where is your at reporting? This one.
That's the middle one.
The middle one. So you just pick the middle one, right? Then you multiply by
Sure.
what? You multiply by maybe if it is 40%, you multiply by 40%. That gives you what? Non-controlling interest. Are you with me? All right. So that is
Yes.
when it is proportionate method. Now let us look at fair value method here. So under the fair value method, I've already explained to you that it means that the subsidiary is what is fairly valued. You understand? So as an example, like maybe I said 500,000. So here, or they can say that maybe it has what? It has number of shares. Number of shares is maybe 500,000. And then the share price is maybe 1 series. So simple. So the total value of this one will give you what? 500,000. It's simple. So now we know the what? We can know the what? The fair value of what? Of the subsidiary. If we can know the fair value of subsidiary, then we can use fair value method to determine the goodwill. So here, all you have to do is that you will come and do your what? Your goodwill. So you will get your goodwill. All right. You will have your goodwill. So out of the goodwill, you have your what? Your purchase consideration. All right. So how much purchase consideration? Maybe you have purchase consideration on this. Okay. Then you will come and then what? Add your add your what? Your NCI fair value. That's non-controlling interest fair value. So what I just showed you here. Example, if assuming it is what? It is this amount that we are talking about. Then you just bring it here. You add it to the what? Purchase consideration. You understand? So whatever you get, then you say that you what? Less net asset at what? At acquisition. Then you go and pick the what? The one in the red, right? The first one in the net asset of the company. Then the whatever you get is your what? Is your goodwill here. So when you get the goodwill, this goodwill can be impaired, right? So you may have what? Impaired goodwill. Do you understand? Or less impairment or impaired goodwill, or you say less impairment. So if part of the impairment goodwill is impaired, you come and what? Less it. So whatever you get becomes your true goodwill. Okay, so that is it about what? About the fair value. So after, if it's the fair value, how do we determine the what? NCI, non-controlling interest. So non-controlling, how do we determine the non-controlling interest? So here you will pick the NCI fair value. So how much is the fair value of what? Of the subsidiary? You know it. So NCI fair value. We already know the what? The fair value of what? Of the company. You bring it here. If there's any share to be what? To be given, maybe after acquisition, the net asset, there's a surplus, which is what we call what? The post-acquisition profit. So whatever you get from post-acquisition, they will come and share between parent and subsidiary. So that's why you have what? Share of what? Post-acquisition what? Profit. That you come and share it. So everybody will get small, right? Then you add it. So whatever you get is whatever. So if there is also impairment loss in the question, you also come and share it between the parent and the subsidiary. So you come and what? Share it between this one. So I want to come here. So whatever you get is the what? Is the value of what? Of the subsidiary. And then so that is it about that one. So the next one is what? Is parent portion. So the parent portion is what we call retained earnings. So that's fifth one. That's retained earnings or parent consolidated retained earnings. You can say that.
Okay, number 5.
Consolidated retained earnings. Okay. All right. So here you have. So you go into the balance sheet. In the balance sheet, you have or some financial portion. You will see that there's what the retained earnings. You will bring the what? The opening balance here, right? You will bring it here. Right? Okay. So if there's anything to less, you will come in the less. It may be post acquisition profit. That will what you will show it here. You will bring it here. If there's what impairment, you say share of what impairment. If NCI is what you see is NCI is what is fair value. So you'll bring it here. Watch it here. There's a reason why I brought that one. If NCI is not fair value and you use proportionate method,
Fair value.
if NCI is not fair value and you are using proportionate method, if you are using
Yes, sir.
proportionate method and there's impairment of what? Of goodwill, they don't share the goodwill. They don't share the impairment. You will pick all the impairment and come and what do you call it? You will come and credit it to the consolidated retained earnings. If the NCI is fair value, they share the what? The impairment loss between the subsidiary and parent. Are you with me? But if NCI is not fair value and they use proportionate method, the 100% of what? Of the goodwill impaired will be brought here. A lot of items will come here, but let me skip those ones and later we will see them. Later we'll see them, then I will show you why they are here. Something like, let me bring it here. Something like unwound discounts. Unwound discount will also come here. Because it's a loss, it will what? You will less it. You have your what? Your and then finally 6. Maybe if it is what? It is associate. So you have what? Investment in what? In associate. Right? So you have investment in associate. So how much did you invest in associate? Maybe that's what we call cost of what? Of investment. Maybe you invested in a company you don't control. It's just our investment in those company. If there is maybe share of post acquisition profit between the parent and associate company, that's what we call post acquisition profit.
Okay.
They will come and share it. You understand? So you share that one. So how is this arise? Maybe at the end of the accounting year, this company, maybe the company has investment in what? Company A has investment in what? In company what? In company C as what? As associate company. At the end of the accounting year, or maybe they acquire the company on first maybe 30th June, right? 30th June 2020. And at the end of the accounting year, 2020, 31st December 2020. So how many months have they been associates? 6 months. Do you
Sure.
understand? Good. So when they acquired the company, the retained earnings was 30 million. But at the end of the accounting year, the retained earnings has moved to 50 million. You see the difference between that. The difference is what? 20 million. So they will share this 20 million among themselves. Do you understand? Because it's a profit that has come. Sometimes you may see
Yes.
sometimes you may see it in additional information, or they will give you what as a profit and loss account. So they will give you profit and loss account, the net profit. Do you understand? The net profit that they will
Yes, sir.
accrue. Then they will share this number according to their percentage. Maybe company A has maybe 30%. So if they have 30%, then 30 million, 10 million multiplied by 30% is what? It's a post-acquisition profit. Then you bring it here. That's what I'm talking about.
Thank you.
Good. And then if there's maybe unrealized, less what you call unrealized profit, you remove any business transaction between them. You remove it. If company, the subsidiary sold to what? The associate, that one too, we don't agree with their what?
Yeah, sales.
Their sales. So you remove it from that. So this is the what? Is the step by step business combination that I'm talking about. Are you with me? Okay, so
Yes, sir.
we'll end the class here. So this is what
Thank you.
I want you to know.